Good evening to all our investors joining us on this webinar on Excess Arbitrage Fund. Arbitrage, to some it is easy to understand and to some it's complicated. Today we decipher on what is arbitrage, how does an arbitrage fund work, who should invest in it, and where does it sit in terms of positioning of different funds. Cracking the arbitrage code today for us is K. Hariharan. Hari, as he's fondly called by all of us at Axis, is the learning and development head since April 2020. He has an overall experience of more than 16 years in financial services. Hari is a motivational speaker and has conducted more than 870 plus workshops in retirement planning and financial planning for over 1.5 lakh investors. He has also conducted more than 2,400 plus sessions for MFD IFAs on various topics ranging from asset classes to life-changing programs. Hari also blogs in personal finance and has written a book called Money Money. Before I hand over the reins to Hari, may I urge all of you to use the chat box for any questions that you may have. Hi, Hari, welcome.
Thanks, Shalini. So good evening, namaste, namaskar to all of you. Welcome to this session on arbitrage funds. As I start this webinar, I feel very, very proud as an Indian. This week has been an historic week. I'm sure all of us know that we have been tracking this. The successful landing of the Chandrayaan 3 on the south pole of the moon, right? On the market front, the Indian markets continue their good run and is one of the best performing markets if you look at globally, compare it globally as well on a 1 year basis. The Nifty 50 has given about 16% returns. Of course, the mid cap and the small caps have done better. They have delivered about 27 and 30% returns in the last 1 year. I call this as the Gar Wapsi of the FIIs. And what we saw last year was a complete outflow of money from the FII side. This year, we are seeing a continuous flow, especially in the last 4 to 5 months. And if you look at the net inflow that FIIs have done now, it's about $15,000 million. Most of the macroeconomic indicators in India are looking quite good. If you look at GST collections, they have been consistently clocking more than 1.4 lakh crores. The PMI indices, both manufacturing and services, have also been also been on the expansion zone for the last 24, 25 months on a consecutive basis. Similarly, if you look at inflation, though the CPF for the last month has come at 7.4%, by and large looks under control, barring the steepness in the prices of vegetables, and hopefully we would see some kind of moderation there in the next quarter or so. In terms of the formalization of economy, both the direct taxes and indirect taxes collections have been quite good. Earnings seasons, if you look at quarter one results, if you look at the Nifty 50 companies, you will see that the revenue of these Nifty 50 companies have grown by about 5%. But important, if you look at the profitability, we have seen that there's almost a 33% jump in the profitability on the quarter basis. In fact, the highest in the last 6 quarters. So companies have clearly reaped the advantage or the benefit of lower input cost, and that has sort of helped them to expand their margins. Some of the sectors have done well. Banking, automobile have done reasonably well. If you look at the RBI commentary, there were talks of the rate cuts, but that seems to be a bit deferred now, and hopefully the higher interest rates will continue for some more time. Of course, the monsoon, if you look at it, monsoon has been reasonably good. Even though we started a bit late, it has sort of caught up in the month of July. And out of the 36 subdivisions in the country, about 30 subdivisions have either got excessive rainfalls or normal rainfall. In terms of capex, the government capex continues to be strong. Corporates today are in a very good position, especially with the deleveraging that has happened, to really take the capex forward. So the capex cycle, thrust of the government on infrastructure, the consumption story are some of these stories which are expected to propel India to the $5 trillion economy. With these economic backdrops, you will also see that the mutual fund industry has also grown considerably. There have been record inflows by way of SIPs. A lot of money has flown, especially in mutual funds, into mid caps and small caps. and that has to a large extent been driven by the fact that the mid caps and the small caps have delivered a far better performance as compared to large cap. Another category that has seen considerable amount of flow is the arbitrage category, and that is what we're going to talk about today. If you look at the flows in the month of July itself, more than 10,000 crores of money has flown into arbitrage category, and in this financial year, we have seen more than 24,000 crores of money coming into arbitrage. And there are reasons for it, and that is what we will discuss today. And therefore, the discussion that we will have today on arbitrage is going to be on what will keep this category busy in the next few months, right? So with that, let me take you all to the presentation on the arbitrage. Shalini, can you confirm if the screen is visible? Shalini, is the screen visible?
Yes, it is.
All right. So let's talk about the arbitrage fund. And as I said, a lot of money has flown into this category. So let's understand category wise, what is, first of all, let's understand what is arbitrage. So let me take a very simple example to explain this concept. Let's take the example of Mahesh. And I'm going to take the example of one of the item, which has given a lot of pain in the recent past. It's the example of tomatoes. So let's assume that Mahesh wants to go and buy tomatoes in the market. And there's one vegetable vendor who's just outside his building who is selling tomatoes at, say, 100 rupees per kg, right? And while he's about to go to this vendor and purchase tomatoes from him, he meets one of his society friends. And his society friend tells him that, hey, Mahesh, if you go about 1 kilometer from our residence, our society, there's another vegetable vendor who is selling tomatoes at 90 rupees per kg. So while Mahesh is about to go, he thinks of an idea. He feels that the vegetable vendor who is just outside my society is selling it at 100 rupees. If I travel 1 kilometer, I will be able to get tomatoes at 90 rupees per kg. Now, what strikes him is the fact that the item is the same, which means the tomatoes are the same, but there's a difference in the price of tomatoes between both the markets. And that is what Mahesh tries to capture. So, what does he do? He goes to the market, which is 1 kilometer away from his place, buys the tomatoes at 90 rupees, and sells it at 100 rupees in the market just outside his society, right? So, by doing this, he is capturing or getting 10 rupees as profit, isn't it? Now, if you look at it, is there a risk in this particular investment? The answer is no. There's perhaps a travel cost. There's a time that is required to go and get that vegetable, tomatoes, and come and sell it here, right? So there's a what we call as a cost involved. Risk does not seem to be there, right? And this is precisely what is the concept of arbitrage. So in a very simple language, arbitrage means opportunity, right? And what is the opportunity that Mahesh got here? The opportunity that the prices of tomatoes in two different markets are different. And he's trying to take advantage of this mispricing in the prices of tomatoes, right? Let's come to the world of investment to understand the concept of arbitrage. Now, the very tenet or principle of arbitrage here is based on the fact that markets are inherently inefficient in pricing the securities, which means that there will be some small price differences in the same security across different multiple markets. So let's take a very simple example again from the market context. We have two major indices. We have the BSE, which is the Bombay Stock Exchange, and we have the NSE, which is the National Stock Exchange. Let's assume there's a stock A, which is trading on the Bombay Stock Exchange at 100 rupees. The same stock A will be trading in the National Stock Exchange at, say, 101 rupee. Possible? Yes. So what is happening? Same stock in two different indices markets are available at two different prices. So I can buy stock A on the Bombay Stock Exchange at 100 rupees and sell it on the National Stock Exchange at 101 rupee, and I can profit 1 rupee, right? So this is the concept of arbitrage, right? In the equity market, the arbitrage opportunities arise because of differences in price between the cash market and the derivatives market. So what is this cash market? It is also called as the spot market. Now, in a cash market, if I have to buy stocks, okay, let's assume that I want to buy TCS shares. And if I want to buy, say, 100 shares of TCS, and let's also assume that the price of one share of TCS is 3,000 rupees. So, in the cash market, if I have to buy 100 shares of TCS, I will have to pay 100 multiplied by 3,000 rupees, which is 3 lakh rupees. I will have to make the payment and take the delivery of the shares into my demat account. So, this market in which there is a physical transfer and delivery of shares that is happening into the demat account, and where you pay the entire amount upfront, is referred to as the cash market. Based on the cash market, there's another segment in the equity which is the derivatives market. And if you look at the word derivative, there is something called derived. So, which means derivative market is a market which is derived from an underlying market. And when we talk of derivatives, in this particular market, we are able to transact in securities in the way that I will not take possession of that particular item today, but I enter into an agreement or a contract, and the buying and the selling will happen at a future date. I only decide the price today. Okay, so let's take a simple example again. Let's assume that I want to buy a mobile phone. So one option is I go to the mobile store, and let's assume the cost of the mobile is, say, 40,000 rupees. I take cash and I pay the entire 40,000 rupees and purchase the mobile. The other option is that I go to a derivative market here. Let's create a hypothetical derivative market for mobile. And I say that I go to the shopkeeper and I say that I want to purchase a mobile. I don't have the money today, but I want to block my mobile today, in the sense that I want to fix which particular mobile handset I want to purchase, but I will purchase after
Hari, could
1
I
month.
interrupt you here?
Sorry?
Hari, I need to interrupt you here. Could
Yeah.
you just dismiss the hide button from your screen?
Sure.
Yeah, that will help. Thank you so much. You can
Okay. Yeah.
continue.
Yeah. Sure. So the other option is that I go to the shopkeeper and I say that I like this mobile. I want to buy it, but I don't have the money today. But I'm expecting some money to come in the next 15, 20 days. So I tell the shopkeeper that I will come back after 1 month. I will buy the same handset. I'm fixing it today. And let's also fix the price. Okay. So the shopkeeper says, okay, let's do a deal. Let's fix the price for the mobile at, say, 40,500 rupees. In the cash market, I was buying this mobile at 40,000 rupees. I fear as a buyer of the mobile that when I buy the mobile after 1 month, the price of the mobile phones could go up. And therefore, I try to lock in the price today. So I go to the shopkeeper and say that I will buy after 1 month. Let's fix the price. I will take the delivery of it or the possession of the mobile after 1 month. So this market is referred to as 40,500. So this market is referred bought or sold at a future, right? That's the derivative market. And something. And the very simple example that I could talk about, right? So curd is derived from milk, right? So milk is what we call as the underlying, and from this underlying is derived the curd. So curd is referred to as the derivative, right? And therefore you would appreciate the fact that as the price of milk changes, the prices of curd will also change. So if the milk prices go up, technically the prices of curd should also go up, and vice versa. Okay, so that's the derivative market. And in the derivative market, when we talk of arbitrage, we're going to talk about futures predominantly, and of course the derivative market also has options, right? So I will not get into what is futures, but I think this sort of sets the context of what is the kind of arbitrage opportunity that exists.
Hari,
Yeah.
could you just go back to this again, the last almost 1 minute, because I think you were just going off, the signal was a little erratic. So if you could just explain the last 30 to 45 seconds again.
Okay. So I said that there's a cash market, there's a cash segment, and there's a derivative segment. In the derivative segments, we will restrict our discussion only to futures, because that's what predominantly is used as part of the arbitrage strategy, but derivatives also as options, right? So, with that, let us understand this. When we talk of equity arbitrage, I said that the derivative market is where you enter into a contract, and the equity market in the derivative space offers what is called as a weekly contract and a monthly contract, right? And these contracts expire. So the monthly contracts will expire on the last Thursday of every month, right? So there are a few things that is important and relevant from an arbitrage perspective. One is what is known as the spot price. This is nothing but the price of the security in the spot market or the cash market. So, for example, if I were to look at, say, State Bank of India stock, and let's assume that the stock market, the price of the State Bank of India stock today is, say, 570 rupees. Okay, so that's the price of SBI one share, and that's called the spot price. The same SBI will be available in the derivatives market. And as I said, I will restrict our discussion only to futures. So there will be SBI futures which will be available. And this SBI futures will have three different contracts for three different months. There is one contract which will be for the same month. So in this case today, when you're talking of August, 31st August happens to be the last Thursday. So there will be one contract which will expire on 31st August. Then there's another next month contract, which is called the mid-month contract, which will expire in the last Thursday of September. And there's a far month contract, which will expire in the month of October. So there are three contracts that are available at any point in time. And that's the future segment, right? So in the future segment, the same SBI stock, the August expiry is said trading at, say, 572 rupees. In the spot market, SBI is available at 570. In the futures market, August expiry contract, it is available at 572. So there's a difference of 2 rupees between the spot price and the future price. And ideally speaking, the future price should always be higher than the spot price, right? And this difference is what is called as spread. Okay, so the spread is the difference between the spot price and the future price. So 572 minus 570 is the 2 rupee spread, right? And when you transact in derivatives in future market, you're supposed to pay a margin. Okay, and that margin is what is also available, and what the fund managers will use is typically use a part of the money to keep it as a collateral to do these derivative transactions. So these are key things that are relevant. What is more important conceptually is that today the spot price and the future prices are different. And on 31st of August, this contract of SBI will expire. On that day, this contract will expire. And this contract will expire on 31st of August. Okay, so this is what you see as the graph here. We'll understand this in more detail. So if you look at this particular slide, what you see on the right hand side is the spread. Spread is nothing but difference between the spot and the future. What you see on the left hand side is how the spot and the future price movement are happening. So you will see that they are almost in tandem with a marginal difference that is because of the spot, right? On the day of the expiry, the spread will become zero, and the spot price and the future price will merge. So let's take an example to understand all this. So we said that arbitrage is opportunity. And we said that there's a cash segment, there's a derivative segment. So what the fund manager does in an arbitrage is
Hari,
that,
Hari, we've lost your presentation.
okay, one sec.
Yes, can see now.
Okay.
Yeah.
So let's take an example to understand this. Um, so we said there's a cash and there's a futures. So what the fund manager does in the arbitrage is he is buying and selling simultaneously. So if you were to take the example of so what is there in the slide, that's the fund manager will buy the share or the stock in the cash market, and let's assume that the price is 100 rupees, and the same stock is available in the futures market, and we said that the future price will typically be higher than the spot price. So let's assume the future price is 101 rupee. So what he does is he buys the stock in the cash market at 100 rupees, simultaneously selling in the same stock in the futures market at 101 rupee. So by doing this, he is locking 1 rupee profit. And how does it work? Let's take three different scenarios. The first scenario is that on the expiry date, I said that the spot and the cash prices will merge, the cash and the futures market will merge, they will become the same. Let's assume on the day of expiry, which is 31st of August, in the example of August month, the stock prices becomes 105 rupees. So he has bought the stock at 100, that 100 has become 105. So in the cash market, he has made a profit of 5 rupees. Now, because he's bought it, he has gained 5 rupees. He has sold it in the futures. When we sell the future, it is to say that so there's a loss of 4 rupee on the future transaction. In the cash, I have made a profit of 5. So the
Hari,
net.
we've lost you again. Your presentation is gone. You'll have to reshare your screen.
Okay, why is this happening constantly? I'm sorry about this. I hope it has come back.
Yeah.
Okay, I am extremely sorry. These are technical glitches. So I was at this point that the stock prices go to 105. So I make a 5 rupee profit in the cash segment, but in the future segment I make a loss of 4 rupees. So my net profit is 5 minus 4, 1 rupee. The second situation is that the stock price does not move at all, and it closes on the expiry day at 100 rupees, the same price at which I bought it in the cash market. So I bought it at 100, and in the cash on the expiry date it is 100, so I make no profit there. But I have sold it in the futures at 101, so I make a profit of 1 rupee again. The third situation is if the stock price comes down, and let's assume it comes to 95 rupees. I bought it at 100 in the cash, it is now at 95, so I make a loss of 5 rupees in the cash segment, but I've sold it in the futures market at 101. So I make 6 rupees profit in the futures market. Again, my net profit is 1. So if you look at all the three situations, by locking into this arbitrage, which is buying in the cash and selling it in the futures market, I am locking that 1 rupee profit. And that is what makes arbitrage and arbitrage funds a riskless investment. Okay, so the objective is to lock that profit, and that is what the fund manager will keep doing in an arbitrage fund. So the next question is why arbitrage fund? As we have understood, arbitrage will try to take advantage of the opportunities that arise because of mispricing in two different markets. Two, by using this strategy and as the illustration that we saw, I am able to sort of lock in the gains, right? Third is that all these positions are taken simultaneously, which means you buy the stock in the cash market, simultaneously sell it in the futures market. So you are taking what is called as completely edged portfolio, right? Because of which you are completely neutralizing any kind of risk associated with that particular stock. And for other important point is that by locking in the because it's a completely edge
Hari, we've lost
portfolio,
you.
and that is returns which is sort of expect. And you are also trading in a segment which is liquid. So you basically trade in both the markets.
Hari, we've lost you. Sorry, guys. I think Hari's facing some network problems. He's trying to connect back.
Am I back?
Yes, Hari. I think, yeah, we've lost a presentation again. Yes.
Has it come? Okay. So I was referring to why arbitrage funds, and I was talking about the last point, which is basically because you're doing a completely edge transaction, there is a safety element here, and you try to do what is called as a riskless transaction, just like the example of the tomatoes that I started with. And then, of course, you also know what is the kind of returns because you're locking in the price and the profits, and you are basically dealing in those stocks which are available on both the cash market and the derivatives market. So liquidity is also taken care of, right? One of the biggest advantage of arbitrage funds is equity taxation. So if you look at the composition, and I will come to that in a moment, but broadly, if you look at it, the fund manager will do these arbitrage transactions, which is take exposure in the cash market, simultaneous opposite exposure in the futures market. So the equity exposure, they will try and maintain more than 65%, and by doing so, these funds will qualify for equity taxation. Very important point, because this is one of the biggest advantage of an arbitrage fund vis-a-vis the other mutual funds, which can sort of compete in terms of the parking space for the extra additional money that an investor has. So from a taxation perspective, just like equity, which means in the short term, so which means if I buy and sell an arbitrage fund before 1 year, it will be called as short term. I make a profit, it's called short term capital gain, and on that profit I'm supposed to pay 15% tax. On the other hand, if I buy the arbitrage fund today and I hold it for more than 1 year and I sell it after 1 year, I make a profit, that's called long term capital gain, and I have to pay 10% tax on the profit. And in the long term, there's also an additional clause that up to 1 lakh rupees of profits in a financial year is exempt from any kind of tax. So let's take an example. If I have invested a lakh of rupee today and I sell the arbitrage fund after 1 year for say 2 lakhs, so I made a profit of 1 lakh, but because I'm allowed an exemption of 1 lakh in a financial year, I don't pay any tax, right? So this is the advantage and a clear-cut beneficial benefit that arbitrage fund provides vis-a-vis other competing products, right? So the investment strategy that we will follow is, as we already discussed, you basically try to take advantage of the mispricing between the spot price and the future price, which is basically the spot and the derivatives market. And because I already said that it's going to be simultaneously taken, so it's a completely edged position. The risk is managed, right? And there is some element of money that is so I said about the derivatives market. When you take position in the futures market, you're supposed to give some margin money, okay? And that margin money typically is kept in the form of debt mutual fund. So in a debt mutual fund, that money will also earn some interest or a coupon, right? If you look at the mix of the portfolio of the Axis Arbitrage Fund, we are running about edge portfolio is about this is actually slightly outdated. The number is about 72% is the edged portfolio. Okay, the mutual fund units is about 14%. The debt is about 13%. So pardon me for this slide. The edge equity is about 72%. So we are running about 72% edged equity, and we about 90 issuers, 90 issuers. The mutual fund units is about 14%. Right. So if you look at it, the mutual fund unit I said is what is typically used as a margin, and it is done by way of investing in debt mutual funds. And in the current situation that we are in, where interest rates are almost at the peak level, we are able to capture the advantage of higher yields on those debt mutual fund as well, right? We also take some exposure to government securities and some debt instruments directly as well. Okay, so that is what you see as debt and cash, and then we have mutual fund units. So this is broadly the portfolio mix of the Axis Arbitrage Fund. Interesting point to note is that one of the things that works favor of the arbitrage fund is what is called as the spreads, which is what we discussed. And typically the fund manager, so for example, we are in the month of August, so the August contract will expire on 31st of August. But if the fund manager wants to now take this forward to the month of September, we call this as rollover. And that is where you also look at what is called as a rollover spread. And the rollover spreads for the month of July was at 74. The one interesting point to note is that over the last say 7-8 months, we have seen that the rollover spreads have been quite good, typically in the range of 60 to 70, 75 bips. So one way to look at this is that this is a monthly rollover, so 60 to 70 bips per month. Just to sort of annualize is multiplied by 12, you get about 8.4% or 8%, 8.5%. Please remember, this is not to tell that the fund will deliver that kind of a return. This is just an approximation that the yields have been the rollover spreads have been quite good over the last few months. Now, what is also going to contribute to the spread, and what is also going to contribute to the mood of the market is the fact that we have seen continuously a lot of FII flows, and then there is also a retail support which is coming by way of SIP books. So all of this is sort of giving us a lot of good indication of the bullishness in the market. And if you also look at from a stock specific perspective, you will see the earnings have also started coming in, and that earnings will also contribute in terms of creating opportunities. Because when you look at the arbitrage, the fund manager is going to pick up certain companies where he's going to do that arbitrage transaction, and therefore the earnings will also have an impact in terms of higher spread. So a company which is doing well, good in terms of the business, the future price of that stock will also tend to be higher, and therefore the spread in that particular stock will be higher, and that is where the fund managers will be able to take advantage of. Okay, so all these are factors which are favorable to an arbitrage scheme, right? Few things that is important before we invest is the risk and the return. We said that all the positions are completely edged, so therefore you're not taking any market specific risk here. And point to be noted is that arbitrage funds will tend to do well when there is volatility in the market, right? And therefore you will find that the returns from arbitrage funds will be better in markets which are more volatile as compared to a flat market, right? Where the returns could get a bit subdued. Also, important point to note is that while we said that arbitrage is a riskless transaction, there could be instances where you could find that temporarily even arbitrage funds could give negative returns or very low returns, because of market volatility and fluctuations. But typically, if you hold it for a 3-month kind of period, you will find that it sort of auto corrects, and investors generally get decent returns. Now, what is the kind of investment horizon one should have? We are of the very strong opinion that any investor who comes to arbitrage funds must come with a minimum 3 to 6 month time horizon. I know a lot of investors who have tried to do it by investing for only 1 month. And as I said in my previous point, there could be cases where after you invest, the arbitrage returns could be negative for few days. It could be 1 day, 3 day, 5 days. And therefore, be mindful of the fact that when you come to arbitrage, come with a 3 to 6 month cycle, so that if there are those kind of intermittent um, uh, negative performances, those would get auto corrected in that 3 to 5 months or 6 months period. Okay. Um, this is broadly the fund. Um, and this is where I will also stop. Shalini, we can take some questions if there are.
Yes, Hari, we have quite a few questions. Now, really thanks a ton for explaining it so simply and comprehensively. Most of
Thanks.
the questions that have come into us are the ones which you have already answered, but I think this can serve as a recapitulation of whatever you have said. So I'll ask you pointed questions, and you can perhaps answer them again. Uh, you know.
Sure.
So my first question to you is, what are the key things an investor should look at while deciding which arbitrage fund he should invest in?
Okay, it's a very good question, Shalini. And there are a few things that investors should definitely consider before they evaluate an arbitrage fund. The first is the expense ratio of the fund. Now, why am I talking of the expense ratio here? Is that typically when you look at the performances of arbitrage funds, you would get single digit returns, ideally, which would be in the range of, say, 5 to 8%. And that is where expense ratio becomes important, because if you have a very high expense ratio, it will be detrimental to the overall performance from an investor perspective. So expense ratio is one thing that has to be considered. Two, I said that in the arbitrage, there's going to be a mix of arbitrage and some element of fixed income or debt mutual fund. So look at what is the mix in that particular scheme between arbitrage and debt. Why it is important to look at is because when you invest in debt markets, either by way of the instrument itself or by way of the debt mutual funds, there are some risks that gets added to you. One is in a debt mutual fund, there are issuers, and there are papers that the fund manager will purchase. So therefore, it's important to look at what is the credit quality of the underlying portfolio in the debt mutual fund, because the credit ratings can be different, and basis the credit ratings, your credit risk can also change. So look at what is there as part of the debt mutual fund. Similarly, in the debt mutual fund, you also need to look at what is the duration that is there in that particular debt mutual fund portfolio, because duration is nothing but it's a measure of the interest rate risk, and therefore it's important to evaluate that. And longer the duration, higher is the interest rate risk, and interest rates and prices tend to work in negative directions or opposite directions. So therefore you have to be mindful of the fact that what is the duration that is being run in the portfolio. The third element to look at in the debt is what is the current YTM, which is the yield to maturity of the fund. Okay. Then of course you look at if it's a fund which is there for a reasonable amount of time. Also look at what is the rolling returns of the fund across different cycles. So that gives us a picture of how consistent has been the performance. The other element to look at is the asset management company itself, which AMC you're looking at, what has been the track record of the AMC, what is the style of investment, what is the philosophy that they follow. I think that also gives a lot of conviction to investors. And finally, one interesting point that I want to touch upon here is the size of the fund. And because it's an arbitrage, it's an opportunity that you're looking at, and there is a specific set of stocks available in the derivative segment. My sense is that smaller the fund in terms of AUM, the better it is. Right? I think these are some of the parameters one should consider and evaluate before you finalize a particular arbitrage scheme.
Hari, my next question to you is, who are the investors who should look at investing in an arbitrage fund? And what are the risks involved for them?
Okay, so clearly this is a fund for people who have a lower risk appetite. So people who have lower risk appetite should come to this fund. People who want to park their money for small periods of time, and when I say small periods of time, typically we are talking of 3 to 6 months. And I will repeat it again, that please come to arbitrage with a minimum 3 to 6 month time horizon. Don't come for 10 days, 15 days, or 1 month. Okay. So for people who want to park the money, people who are low in terms of risk appetite, people who want a better tax adjusted return, and again I will repeat, it's one of the biggest advantage that arbitrage fund offers is the tax efficiency vis-a-vis the comparable products. And people who are in the highest tax bracket, I'm assuming all of our audience are in the highest tax bracket, and that is where the tax efficiency of arbitrage scores well over other competing products. So these are the points. Risk, again, I will want to stress a few things, very important. I talked about the debt component in arbitrage. So when we talk of debt component, inherently you also take what is called as credit risk. So look at the portfolio. What is the mix of AAA, AA portfolios, issuers? Look at what is the duration of the fund, because that will give a clue of what is the extent of volatility in the event of a change in interest rate. So the interest rate fluctuations can impact the price. So longer the duration, more will be the volatility of fluctuation. So that's a risk that one has to consider. Then there could be certain events, for example, what happened in March 2020 because of COVID. There could be disruption, and all these calculations can go for a toss. And if you go back to March 2020, the future prices, I said ideally should be at a premium or a higher price to your cash market. At that time, the future prices were at a discount, which means you were actually getting negative returns on the arbitrage scheme. So these kind of extraneous events can also disrupt. One interesting thing is that there could be funds which could also at some point in time face a large amount of redemptions that can suddenly come, and therefore when you face such kind of large redemptions that is going to impact the fund will have to exit from the securities, and some of these exits could happen at suboptimal returns or maybe at suboptimal periods of time, and all of these could sort of impact the performance. So these are the risks that one should evaluate.
Okay. My next question to you is, so if I have 1,000 rupees to invest, how much should I put into an arbitrage fund?
I think one should clearly look at investing in arbitrage with a definite purpose. The allocation will depend on what is the goal of the investor. Typically, as I said, this is a fund where you keep your money for very, very short periods of time. So it's a parking money, something that you don't need today. It's idle money. Instead of keeping it in a savings account, you can keep it here. Okay, I think that's what you'll have to look at it. Instead of defining a specific percentage, whatever is idle money, shift it here.
Okay. So my next question to you is, how can we compare arbitrage fund to an FD or to a liquid fund or to an ultra short, given that the time period could be the same for all? So how would you compare these funds?
Okay, again, very interesting. And as I said, arbitrage, one of the biggest advantage that arbitrage offers is the taxation. So, and I'll quote some numbers here, because that's very interesting to look at these. So, I have done this evaluation of arbitrage fund versus a liquid fund uh, on a 3 month basis. Okay, so let's assume that if you'd have invested a crore of rupee in 3 months back, so we are talking of August. So the data that we're talking of is roughly about 23rd of August, just a couple of days back. So 3 months prior to that, so 1 crore invested in a liquid fund, 1 crore invested in an arbitrage fund. Both of them have yielded similar returns, almost 1.67%. So liquid has delivered 1.67, arbitrage has delivered 1.68. This is a 3 month absolute performance, but the difference comes in taxation. So assuming that the investor is in the highest tax bracket of 30%, the moment you apply tax, so in the case of debt mutual fund, which is liquid, ultra short, all the money market instruments and all debt mutual fund rather, because you're holding it only for 3 months, you get the short term capital gain there, which is 30%. In the arbitrage, I said that when you sell it before 1 year, you pay only 15% tax. So the tax is half. And the advantage of this is that on a 1 crore investment, even though the differential in absolute return is only 0.01%, the moment you apply tax to it, you find that you will have actually earned roughly about 26,000 more in an arbitrage fund versus a liquid fund. And I'm talking of a 3 month period. The moment you take it to 6 months and 1 year, the similar pattern is observed. In fact, the quantum of money that you would have generated by investing in arbitrage is much higher than what you would have done in a liquid or a ultra short kind of investment. So net arbitrage offers tax efficiency in terms of short term gains only at 15% vis-a-vis comparable products, and typically people would go and do a investment in ultra short or the liquid, the comparable products where the taxation is as per the income tax slab. So you will have to look at that parameter, and from a tax perspective, arbitrage clearly scores.
Hari, you mentioned that arbitrage funds tend to perform well in volatile markets. One of our
Yeah.
investor wants to know what are the designated entry and exit points, and how should he be able to take advantage of arbitrage in the market. So, how would you respond to this? What would be the
Yeah,
answer
I
to
think
this?
again a very interesting question here, because volatility and arbitrage are a match which is made in heaven. Okay, so clearly volatile markets are friends for arbitrage funds, and therefore timing in a way makes a lot of sense here. Okay, and therefore to understand those elements, which could positively affect the arbitrage market and the space, is to look at a couple of points. One is that in a bullish market, so when the market is bullish, sentiments are positive, you will find that These are good points to enter into arbitrage schemes. I also talked about future price and the spot price, and there's a future prices is trading typically at a premium. So the difference is what we call as cost of carry, and to that extent, high interest rates are favorable for arbitrage. So sentiments positive, bullish mood of the market, high interest rates. I think these are conducive environment for arbitrage. And if just to sort of extrapolate it to the current context, we have seen a lot of money coming from FIIs. DIA money is by and large stable in terms of SIP book, etc. Most of the activity indicators are very positive for India, and I'm sure everybody is keeping talking about the India story, the 5 trillion, the 10 trillion, number 3 in terms of GDP, and so on and so forth. A lot of other things are favorable in the Indian context from a macroeconomic perspective. I talked about the fact that there's formalization of economy that's happening by way of direct taxes and indirect taxes. GST collections are consistently above 1.4 lakh crores. The purchasing managers index, which is again a measure of the activity in an expansion zone for 24-25 months consecutively. So a lot of these are favorable factors. Capex is one big story. Government focus on infrastructure is continuously going on. Uh, Corporates are at a very good position today to expand their capex capacity utilization. Recent numbers have shown that it has come up. That's again a positive indicator. So from a medium term to long term perspective, everything seems to be in favor of India, and therefore that bullish sentiment should hopefully continue for a longer period of time. But I would want to put a word of caution here. It's not going to be a linear upward kind of a graph. You will have those intermittent, maybe time correction, maybe price correction, whatever you want to call it as. But things are very positive, and these are favorable conditions for arbitrage. So just to add on the interest rate bit also, RBI has been on a pause now, and the commentary from RBI seems to be that though inflation has gone up, more to do because of vegetables, it looks to be transient in nature, and therefore the interest rate, which is already at high levels, is expected to remain at that level. So we don't anticipate RBI to cut rates very immediately, and these are again favorable factors for arbitrage, because if interest rate comes down, arbitrage may not be a great entry point. I think that's the entry point and the exit point. When the interest rate starts coming down is the time to come out of these funds, and the entry is now is a good time because the interest rates already are at peak levels. I hope I have answered the question, Shalini.
Yes, you did, Hari. One more question for you. How do we identify and manage risks in arbitrage
So
in the
one way
fund?
to do,
In the
yeah.
fund.
So one way is to do is that. So you're talking from a fund manager perspective, or
Yes, from the fund management perspective, yes.
so as I illustrated, because you're taking exposure in both the cash and the futures market, that's a completely edged transaction. You are taking the same stock, you're buying the same stock in the cash, selling the same stock in the futures. You're completely edging that transaction, and in a way, you're locking the profit, as I showed in that illustration as well. So from a fund manager perspective, those things are happening, and you're basically transacting in only those stocks which are available on both the markets. So it's not a naked transaction that is happening. It's a completely edged portfolio. Two, in terms of debt, again, as I talked about when we talked about the risk, at Axis, we are playing pretty safe even in terms of debt. Our current YTM in the debt portfolio is about 7%. We are running a very short maturity there, very short duration of 130 days, which means roughly we are talking of about 0.35 as the interest rate sensitivity. So these are precautions that are taken. Credit quality is 100% AAA. I think that also gives a lot of comfort. So all of these are factors which are taken in by the fund manager to ensure that the investment is happening in good securities. As I said, market extraneous factors could impact them momentarily. Um, Yields are good, the spreads are good. It's a good time to lock into arbitrage funds. At least the next 2 to 3 quarters reasonably look attractive from an arbitrage perspective. So I think from a risk mitigation perspective, these are steps that are taken by the fund manager.
Okay. So I think that's about it, Hari. Thank you so much for this insightful session. And I think a lot of the questions have been answered. People now understand what arbitrage means, when they can enter, exit, the risk associated with this category. Thank you so much, Hari. And
Thanks.
big thank you to all our investors who have taken time out on a Friday evening. Thank you for joining us and have a happy weekend. Bye.
Thank you so much. Bye bye.
Bye.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.